met with many, many, many thousands of millionaires over the years. How did they invest? What are they doing? Well, we suggest, and I personally invest in good growth stock mutual funds. I spread it across 4 types: growth and income, growth, aggressive growth, and international. And I buy mutual funds that have at least a 10-year track record. Well, Dave, shouldn't you just buy index funds? Well, you can if you want. Index funds, basically an S&P 500 fund, mirrors the market. That basically is the stock market. And so you're going to do exactly what the stock market does, good or bad. The mutual funds that I buy outperform the S&P 500, and they're really not that hard to find. A lot of mutual funds don't outperform the S&P 500. So if you're going to buy that, well, that'd be dumb. Just buy an S&P 500. But I buy mutual funds that outperform the S&P 500, and my portfolio mix that I just outlined is pretty much always beats the market because I buy funds that outperform the market. It's not that hard to do. You open up the prospectus, and there's 2 little lines on the graph. One of them is the S&P 500. If the mutual fund you're looking at, if that line is below that S&P 500 line, don't buy that fund. Duh. This is hard. Really not that much to this. But Dave, you just tell people buy those loaded funds. Yeah, they'll pay a commission. That's fine. Have somebody in your life helping you do the investing. All the data says that you'll continue to invest doing that. But when you're out there by yourself with all your theories and some idiot newscaster comes on the evening news predicting the end of the world, what do? You cash out all your mutual funds at exactly the wrong time because you don't have anybody in your corner saying, don't jump, don't jump. Instead, you're just out there with your own emotions and the newscaster, and that's how you pick out when you jump in or out of the market, and that's just dumb. So all the data says a decent portfolio of good performing mutual funds wins.
Good afternoon, everybody. Welcome to my channel. My name is Danny, and this is Data-Driven Decisions. Today, we're going to talk about Dave Ramsey. Dave Ramsey, if you're ever involved in the church, you probably know about Dave Ramsey. He's a really great man for personal finance. He is known for his debt snowball and his 7 baby steps. And what he's great for is, if you're somebody in financial trouble and you have a lot of debt, which is probably 85% of all Americans, he's great to listen to because he's a great motivator. He'll motivate you to pay off your debt using the debt snowball. And it's the old-fashioned way. It's going to be by creating a budget and spending as little as you can, by getting your side hustle on and trying to make some extra money, maybe being Uber driver or delivery, just some way to pull in some more money, and you just put thousands of dollars towards your lowest debt and pay it off as quickly as you can. You run with gazelle intensity to do it, and this is the things he says. And I remember when I was getting out of debt, I was listening to him every day. I was listening to the debt screams, and it was very motivating, and I love that. I was in a lot of student debt out of college, and then I bought a car, and then I found Dave Ramsey, and I got out of all that debt. I don't follow him to a T. 7 years later, I have debt right now. I have a car loan and I have some credit card debt, but I don't like it. And I'm following Dave Ramsey again, to help me get out of that debt. I think I should hold off on investing right now and just get rid of that debt. My car loan is 11% interest, and that's really high. That's more than the stock market. So instead of investing, I should be paying off that debt. So, I'm not gonna just go from lowest to highest as far as paying off debt. I'm gonna attack the one with the highest interest because that's the one I'm paying the most for. So, don't go from lowest to highest with your debt. Just attack the one with the highest interest, and knock that out. So for me, I've got credit card debt, but I'm not paying any interest on it because it's got 0% APR. So why even pay it? I'm just going to pay the minimum until that deadline, and then in the meantime, I'm just going to pay off my car loan. Take big chunks out of that debt, and I'll feel good about that because I'll be paying less in principal, and I can see that I have that measured. Now, there's the other side of investing. Once you get out of debt, Dave Ramsey has investing advice, and sadly, he leads you to the wolves, and it's terrible advice. He tells you to invest in active funds managed by people with high expense fees. He tells you to pay the commissions. There's a video that I'll share in this video that really broadly explains his advice for investing, and I must say it's terrible advice. So, Dave Ramsey, you should follow him up to his step 3 of well, yes, I think step 3 of step 2 is getting out of debt, and then step 3, you build your savings account, and then after that, you just throw Dave Ramsey away, um, because his investing advice is like, it's almost like he's paid for by these people, he's got a big following, and people are listening to what he's doing, and he's like, it's not hard to find funds that outperform the market. You just look at the perspective, and it's there, and it's like, no, it's not, and and that, like, you just buy funds that consistently outperform the market, and it's like, yeah, the assumption is, of course, if they consistently outperform the market in the past, they're going to do it in the future. I mean, what about reversion to the mean? I mean, that's the truth of investing. I mean, it's not as simple as he says it is. Not at all. You won't see funds that just consistently outperform the market. You won't have your hands on those. As a normal investor with just less than $1 million, you're a nobody, and you can't get into those big boy funds where they got all the algorithms working for it, and it turns money into a lot of money. You don't want to invest in active mutual funds. You want to invest in index funds. That's it. That's what Jack Bogle teaches. That's what Warren Buffett teaches. That's what Burton Malkiel, Charlie Ellis, William Bernstein, Richard Ferry, they all say the same thing, and it's invest in index funds, mostly VTI, the Vanguard Total Stock Market Index Fund. And then in the world, you want to invest in VXUS, the international stock market, and that's it. I mean, I do it, more. I have some creative ways of which I do investing. I mean, my portfolio isn't that simple. It's all index funds, and I have some portfolios that have maybe 30 different index funds, all with different allocations that I created. I showed you in other videos using the best portfolios of all the top experts, and then plotting the risk versus return, and then finding the ones with the highest return with the most minimal risk, the ones that are at the threshold of the efficient frontier curve. William Bernstein always talks about that. It's great. So, I don't know what Dave Ramsey's smoking. I don't know what he's not reading. He doesn't, he chooses not to change in his advice, which makes me think he's probably getting commission from the financial institutions to lead people that way. But it's terrible advice. You need to invest in index funds, and if you don't know anything that you're doing, here's what you do: you just invest all your money in VTI, all of it, and try to just invest as much as you can each month. That will win. That will do better than 80% of people every year, and over 20 years, you will do better than 99% of people. I hope that helps. That's it. When it comes to active mutual funds, first of all, no, they don't outperform the market. You're just as likely to underperform the market as you are to overperform the market. You got all these active investors competing against each other, and they have to get the average holistically as a whole. And who are you to say who's the best and who's the worst? To know up front. But anyway, it's just a random guess of what your return is going to be, and it's going to be with an average of the average, because it has to be. And what you're going to lose is your expense ratio, your 3 to 4% that is charged for the people to manage the fund, all the trading that goes on, and all these random stupid fees that they make up that you have to pay, and then it's going to equate to 3 to 4%. So the average stock market return is between 10 10 and 12%. Okay, let's say it's 11%. Well, if you're going to do active investing, your average is going to be 7%. You're going to consistently underperform the market. So if you follow Dave Ramsey, that's what you're going to have happen. You're going to not outperform the market. You're not going to pick high performing mutual funds like he says is so easy. No, that's not easy. It's not like that. You're just going to underperform the market by your expense ratio, and it's going to suck, because your money is not going to really grow that much. There's a big difference between 11% and 7%. Huge difference. With 11%, your money's going to double in less than 7 years. With 7%, it's going to take over 10 years. So, what do you want to do? You know, the sad part about the financial industry is that most people are sharks. They just want to take your money, put you in these high cost funds that they just take a big chunk out of gradually without you noticing. And you get your return. It's always going to be less than, the market average, less than the expense ratio. So consistently less than what you ought to get. And, they're going to be doing well. But moral of the story, don't follow Dave Ramsey up to step 3. Just knock him out, stay out of debt, don't get into more debt. Maybe for good things like real estate, you can get into more debt. Credit card debt, you manage it well. Credit cards are necessary. You need credit cards for security, for fraud. Fraud happens all the time. People are always after your money. Fraudulent transactions always take place. If it's on a credit card, you just call the company, tell them what transaction it is, and it takes it away right away. No questions asked. If it's on a debit card, if it's with a bank, then you're probably not going to get your money back. So that's the reason number 1. Reason number 2 is if you make a transaction with a bad company, something you don't want to do business with again, you can always just get a new card, and that's really easy. I guess you can do that with a debit card, but debit cards don't protect you against fraud. You just want to make all your transactions on credit cards. Plus, you get the rewards. You get 2 to 5% rewards on all your transactions. That's awesome. Plus, you get like a 0% APR for a long period of time with a credit card, and that gives you free money for 15 months. I always take advantage of that. I'm doing that right now with my Fidelity card. I just bought it. It was great. $15,000 credit limit, 2% cash back on everything. I don't have to pay anything for 15 months. So I'm just spending on that card, and then all my other credit card balances are going to be low, and I don't have to pay them much for them, and that's going to allow me to grow my checking account. But yeah, the video, the moral of the story is don't follow Dave Ramsey for investing advice. Watch the video that this is what he tells you to do in the video I'm going to show you, and it's terrible advice.